for last. So this panel 3, is examining micro market structure and trading technologies. A couple issues that we tangentially touched upon earlier in the day. Panel will discuss a number of contemporary trading and technology issues impacting the market. These issues include the maker-taker pricing model, we talked about that, order protection rules, trading algorithms and order types, locked and cross markets, remember we touched on that, tick size reform, consolidated audit trail, I don't know if we touched on it too much yet, and volatility protections. Hopefully we'll get into a little more detail on each of these areas as we go forward. Let me just go around the room here, starting right here with from T. Rowe Price, head of U.S. equity trading, Mr. Andrew Brooks. From Charles Schwab, senior VP in Ledge and Regulatory Affairs, Jeff Brown. From RGM Advisors, Chief Executive Officer, Richard Gorelick. Greetings. From BATS, Chief Operating Officer, Chris Isaacson. Oh, over here. Okay, swing it around over here. From NASDAQ, Executive VP, Eric Noll is right there. From Goldman is Managing Director, Paul Russo, right there. And from ITG, Head of Electronics Brokerage and Sales, Jamie Selway. Okay. And finally, from RBC Capital Markets, Head of Market Structure Strategy, Richard Steiner. Thank you all to the panel. And again, with the format here, I thought it went good, interesting the way we had it last time with more of a back and forth discussion. So I'll just throw something out here just to begin the discussion. Early on in the last panel, we discussed Reg NMS. One was to take that from a 30 or 20,000 foot level and ask the question whether or not it and its requirements are either solving or causing the problems we have today. I guess that's maybe a spin-off of, as he walks into the room, the commissioner's comments before, whether or not technology is driving some of this, or whether it's past regulations, such as in my pinpoint question on NMS. And I'll throw that out to the panel.
I'll take the first stab at that.
Yeah, and I'll preface. Sorry, I just preface my comments. Yeah, make sure that you pull the mics as close as you can for the people in the back of the room.
Sure. So I think as was mentioned on the last panel, we can all agree the U.S. markets, although they may be different than they were 10 or 15 years ago, before a lot of the, really the last decades had amazing change. And NMS, one of several of the big changes. I think you have to start with the fact that the markets in the U.S. are still regarded as some of the most efficient in the world, some of the most competitive in the world. In that regard, whether you measure it in the narrowness of spreads, it's working. I think the issue comes down to NMS. The market had voted at that time that it wanted speed. And I think the combination of competition, which I think Reg ATS started, decimalization, which narrowed spreads, a lot designed to help retail. Particularly, we're trying to protect retail, not sophisticated people who presumably have the ability to protect themselves. And then I think lastly, speed. So it's not technology came first and the market wanted it. I think it was the concoction. And if you really look at the world today, what hasn't been revolutionized with technology in some manner, shape, or form? So the fact that the markets are another example of that strikes me as reasonable. The issue I think that we get particularly concerned about and was commented is, as a result of this more technologically enabled world and a world that travels at this speed, what are the different types of regulation you need to think about, are the different issues? One of the things that we've talked about in several comment letters is market data. My personal view on the flash crash, it's the simplest way to describe it is the world got going so quickly for real reasons. There were real things happening in the world in the funding of Europe that we kind of hit a condition where the market data got distorted, and anybody who programs systems rationally steps back at times when you're not sure what's going on. And I think largely in the flash crash, systematically, we hit a boundary case. So I do think some of the things that were done to address that, limit up, limit down, being obvious things. I think some of these things have already been addressed, but ultimately, I don't think you can roll the clock back. I think technology is here to stay, and we need to continue to adapt the way we think about some of these issues. And again, market data and operational risk, which was mentioned quite a bit, I think those are the next issues we really have to put our arms around.
Anyone else?
Yeah. Well, I'd have to agree that certainly NMS and the technology changes in the last few years have really done very good things for retail investors. Spreads have narrowed, and we heard that some say that retail investors have the best of all worlds right now. While that may be true, there is still a problem with confidence. I mean, even at Schwab, our 10 million, and trust me, it's really nice to hear in this room how everyone's worried about my clients, because and want to do the best thing for them, because that. But we have a duty to them to do what's best for them, and so we look at the confidence issue as a how and we see our clients with an extraordinary amount of cash on hand, still using money market funds to a great extent when there's 1 basis point yield. And so you have to think about the fact that they're not engaged in the market. And if they are starting to engage now, when we're at all-time highs, what does that say about what could happen if we have a hiccup? And will they be shocked again? And will they be driven out of the market again? So I think we have to be worried about that and think about these structural issues in ways that will look long-term, look at stabilizing the system. Sure, speed has had such an impact, and the flash crash and other, just a few weeks ago, we had a Twitter news story. Now, markets have had misinformation forever, but now the impact is immediate and dramatic because of the speed reaction. So these are issues that certainly, as the commission starts to look at it, has to consider.
I think Congressman Garrett and members of the panel, I think some of the other issues, though, when we talk about Reg NMS, I think we can all agree that best price seems to be the fair way for trades to be allocated. But we have de facto in Reg NMS included speed as the secondary function. So I mean, it is almost by definition the fair way as defined by Reg NMS for way trades get allocated. So, at NASDAQ, we tried an experiment. We started a price size market. It never took hold. Maybe it was our poor design that made it not take hold. But one of the things that was clear as we were experimenting with that type of model is that we were in a larger framework that rewarded speed over every other metric other than price. And so our ability to innovate in different ways to create new environments in which trades could take place and be allocated for different metrics, whether it would be liquidity or customer or some other way, we're very limited and constrained by the framework of Reg NMS. It's done very many good things in the marketplace, and I think we can all argue that and agree with that. I think the other thing that, which I think we'll get to as we talk about this, is the complexity of the markets, the number of order types, the number of things that are out there, and how to deal with Reg NMS. And I would say that a tremendous amount of the order types generated out there are to make sure that you can accommodate Reg NMS in the system to meet the requirements of Reg NMS. One perhaps simple idea would be to eliminate the ban on locked and cross markets. It's just let markets post whatever market they're posting. If they do touch or lock markets or cross markets, you then have a pick-em market. And it removes some of the complexity among the competition among exchanges who are all trying desperately to meet the requirements of Reg NMS, but still provide their own competitive prices. And that's a potential suggestion, I think, that could ease some of the complexity in the marketplace today.
So we would from the institutional perspective, kind of echo some of what Jeff said on the retail side, in the sense that by lights of our data, the cost to institutional investors are come in substantially, 60, 70% over the past decade. A lot of that's technology, a lot of that's good market structure. And all that being said, it's far from perfect. So we're sort of incrementalists from the perspective of the debate. I think in terms of Reg NMS, to echo what Eric just said, it's shown its age. I mean, it's been now 6 years. There's certainly things at the margin that we could tune. Prohibition on lock market, that's a nice one. To borrow the Andreessen metaphor, linking all these competitors together like mountain climbers and then asking them to act in tangent, that may not be a healthy thing to do. So maybe something we may want to revisit.
Chairman Garrett, I think this is a very important starting point for this discussion. The idea of Reg NMS, whether it's solving problems or whether it's creating problems. I think, as many people have done today, it's important to start from the recognition that the markets are performing very well by every traditional metric of market quality relative to historical norms in the U.S. and relative to markets around the world. So we want to start off by not messing that up and by looking for incremental ways to make things better. It's been fashionable in recent years to talk about high-frequency trading and to blame problems like volatility or loss of investor confidence on high-frequency trading. But when you really get down and try and figure out what it is that people are complaining about, I don't think they're saying that we don't need professional traders in the market. I think everyone agrees that we need those for price discovery and for liquidity. I don't think anyone is saying that they shouldn't be allowed to use computers. Ultimately, it comes down to these Reg NMS market structure questions that you're asking about. And I think there are a lot of areas where things could be improved. A few of them have been mentioned today. I think the idea of looking at the ban on locked and cross markets is good, both because it adds complexity that could be eliminated, but I think it also does encourage a lot of the off-exchange trading in ways that are sort of subtle and not necessarily obvious, but it's also one way to address that concern. There's another concern about runaway markets, and the SEC and the CFTC, when they looked at the flash crash, one of the things that they were concerned about was how these markets were connected, but also the effect of so much internalization on the volatility that day. And again, if we can go after some of these NMS tweaks around the margin, I think there's opportunity to improve things. Trade at rule may or may not be required. That would be going a step beyond where Reg NMS has been. But looking at things like tick increments could really improve upon some of the work that Reg NMS did. Particularly, people have talked about widening out tick increments for the least traded stocks and the lowest cap stocks. I think there's also an opportunity to really improve the execution for retail and institutional investors by, on the most liquid stocks, looking at something like a half tick. And BATS has proposed a very thoughtful pilot in that regard. So I'll stop right now, but I think there are a lot of things around the margin of Reg NMS that could be improved.
Chairman Garrett, I'd just like, first of all, thanks for the invite today, and Representative Maloney and Hurt as well. I think Reg NMS undoubtedly has ushered in even a greater amount of competition in the markets than there ever has been. BATS was formed in 2005. We put up our first trade in 2006. We've been, I believe, a leader and innovator, part of that competition, and driven a lot of costs down, as Jamie's mentioned. Our exchange competitors don't necessarily like that we're around. They were making, so they were making 3 to 4 times as much, per every trade, and now they no longer do. And I think that benefit is making it all the way down to Mr. Brooks and retail investors. However, certainly things like the flash crash have shown weaknesses. And as Jamie said, 6 years since it's been implemented, there are the flash crash exposed weaknesses around intermarket volatility mechanisms. Dispersed volatility mechanisms do not work. I'm very glad to report, we now have all tier 1 of the most liquid securities operating under limit up, limit down. And I felt like last week, a great example of that actually working well was MBIA comes out with a great settlement with Bank of America, and the market goes limit up, limit down, and it's perfect. There weren't clearly erroneous trades. Limit up, limit down worked exactly the way it was supposed to. Pre-limit up, limit down, we would have had broken trades. We probably would have run many percentage points further than it should have. So I think we've learned that we need technology controls. As technology has caused a great amount of innovation, quicker than the regulation is now catching up. So I think that's all good. Price discovery in a dispersed environment is much different, and people have adapted to that. Now, one thing that's good out of NMS, I think, is market data quality is as good as ever. As Mr. Andreessen said on the previous panel, the manual market and the electronic market could not coexist forever. Nobody knew what the real price was. And so decision was made with NMS that we're going to favor electronic price that's immediately accessible. We think that was a good decision. However, when you favor that, which we do favor, every price is immediately accessible, and everyone who is basing their trades off of that reference price knows what it is. And so off-exchange trading actually becomes easier because the data quality is better. Previous to NMS, you sort of had to go down to the floor and actually to find the real price. So we would say data quality good, but as Mr. Gorelick said, and we've put forward, sometimes the spread is necessarily held wide at a penny for very liquid securities, but maybe that's too narrow for very illiquid securities. We think tick size reform is very important. And looking at the prohibition on locked markets, it has, of all the things that we do on exchanges, price sliding, or how we handle the interaction of orders to avoid locking the market, is one of the most complex things we do in all the markets we operate around the globe. And we don't think it's necessarily good market structure. If the market wants to be locked, if we want to offer a zero spread to Mr. Brown's retail investors, we think that would be great for the market. So I think it's ushered in great competition, reduced costs in a great way, and we start from a great base. And it's working very well for liquid securities, but I think illiquid securities, as Mr. Angel said in the first panel, there could be a lot of work done there to improve.
Mr. Chairman, I too thank you all for convening us together to talk about market structure and Reg NMS and all the issues we face. But I think one of the outcroppings of Reg NMS is we sometimes scratch our heads and wonder who the markets are serving today. Markets open on time, they close on time, trades settle, a lot of good things happening, but behind that curtain, somebody's there with the levers doing some things that don't seem to be as genuine, as thoughtful as they could be. Now, it doesn't mean retail investors aren't well served, and the people that are looking for immediacy get their trades and they get them reported back pretty quickly. But we are aggregated retail, and our orders can't be done that quickly, and we've got to figure out how to stay in the markets a little bit longer than a nanosecond. So the average holding period today in the U.S. for stock ownership is like 22 seconds. That seems not ideal to me. We wonder about people that somehow get separate data feeds when one is faster than the other. And the analogy we talk about at T. Rowe Price is the sting, where the betting window is open, the winner of the race, and you still get to place the bet. That doesn't sound great. And when you tie that into earlier conversations about investor confidence, that doesn't sound great. Now, lots of good things are happening, and gosh knows Wall Street's a creative place, and I'm certain we can come together and be mutually dissatisfied as we look to roll out some pilot programs and some experiments to try and figure out, how can we do things better? I often wonder, when was the last time any of us in our jobs did not have to participate in some introspection, in a 360 evaluation and a self-evaluation? How am I doing? What can I be doing better with my coworkers? When was the last time the market did that? When was the last time the SEC helped the markets really look at some of the things that we brought? And I appreciate that a holistic review of the market structure would be terrific, but by the time that's published, it's 2020. I might be retired, I might not, I'm not sure. I might be pushed out, but it would sure seem, as we wait for that it'd be worthwhile to generate our own data on a condition that the SEC would like to see that data and try and learn from how we can make things better.
I'd like to echo some of Andy's remarks. Thank you, Chairman Garrett, also for convening us. This is definitely a useful message to try and broadcast. I think it's important for Congress and our regulators and policymakers to understand, a bit more beneath the surface what's really going on in the marketplace. And while we can all sit here and talk about the benefits of a lot of regulation, and clearly there has been plenty, we have very efficient markets, we have transparent markets. We shouldn't let that, we shouldn't really rest on our laurels. We should strive to continue to make the market more efficient and more transparent. As Chairman Garrett recently mentioned, the market has grown beyond the regulations that we put in place. And whether it's 6 years since Reg NMS has been in place or 8 years since it was actually passed, it does seem it's time to borrow Andy's phrase for some introspection. And we think that pilot studies, we've been echoing this, we've informally spoken with the SEC and with members of Congress about pilot studies, in particular maker-taker, which is a theme that's been echoed from Professor Angel this morning all the way through the second panel. And a lot of the issues that we're discussing here would probably be addressed by looking at that. And cross markets is one of the things. Lest anybody be confused here, one of the reasons people want cross markets is to guarantee that rebate. I don't want to go take an offer when I can go bid it and make them come back and hit me. So I came first. Somebody now doesn't want to go pay the access fee that we've been talking about to trade with me. I'll just go lock them, make them come around and go pay me for locking them. We don't think that's terribly efficient. It's confusing. There's not much industry support around it. So that's something that maybe deserves a bit more introspection. But if we had pilot studies, and we're talking about limited scope, right? Not skydiving without a parachute here. It would give us the data that the SEC needs, that I know, Chairman Garrett, you have pushed for, that we need data to decide what kind of legislation and rules to make. But a pilot study, again, would allow us to have that data and to try things out, you know, and have a common sense approach, high impact and feasible, and maker taker would be, I think, one that you'd find through the panels today has an awful lot of common ground.
I'd like to respond to that, Chairman Garrett. So maker taker exists to incent displayed liquidity. So rebates are offered to a market maker in order for him to put up a displayed price. Exchanges can operate without rebates or with them. In today's current market structure, one of the concerns is that the incentive to display liquidity is decreasing. So I talk to market makers, I talk to market participants. That's part of my job. And what they tell me is the incentives now are for them to trade more and more off exchange so they can move upstream in seeing order flow. And it's the same players that would normally put up liquidity on exchange. Our concern is that the scales may have tipped far enough that the incentives are not there for them to continue to put competitive prices on exchange at the increments or at the tightness that they would have previously. And then that's a precipitous decline eventually where off-exchange trading becomes more and more, and the publicly displayed price is not as accurate. If we're talking about, you know, doing a pilot where you have to reduce the fee cap or get rid of rebates altogether, as part of that, as Mr. Matheson and Mr. Leibowitz talked about in the previous panel, there has to be something that's equal or greater incentive for the market maker to continue to put up his price. Otherwise, I can tell you what the results will be. There will be higher rates of internalization or off-exchange trading and less displayed liquidity. Because right now, because of the toxicity or the lack of uninformed flow on exchange, there's not going to be incentive for them to put up as much price.
We think that they go hand in hand. The reason that there's so much off-exchange volume, to Chris's point, is because it's so much cheaper to trade up there, right? Many brokers will trade in a dark pool that they own first because there is no access fee, and then go to an exchange which creates toxic order flow on exchange. If the access fee was much lower, whether it's 2 mils, 3 mils, 5 mils, now all of a sudden you don't have to pay 30 mils to take. More of that high quality flow is likely to find its way to other venues because there's not such a differential between trading in this venue for free or a few mils versus trading down here at an exchange with 30 mils. So more than likely what you would have is more flow going, in this case, to exchanges, which would then narrow spreads, because the reason market makers tend to have wider spreads on exchange is because of the adverse selection and the toxic order flow, because basically all of the good flow gets siphoned off, either internalized payment for order flow or trading for an inexpensive or free access fee. And then finally, as a destination of last resort, to the exchanges, which is, to Chris's point, where you find wider spreads than they need to be. So if one addressed maker-taker, true, it would more level the playing field to where the exchanges' access fees would be more in line with dark pools. And the reason exchanges can't just lower their access fees is because they can't just not pay rebates, to Chris's point. We've seen it done before. If an exchange were to say, okay, we'll only rebate 2 mils, and we'll only charge, 1 mil, we'll rebate a mil, we'll only charge 2 and rebate 1. No one's going to go there because basically they want that rebate to post.
It would be really interesting and really fun, I think, if we rolled out a pilot that said no payment for order flow, no maker taker or very de minimis, and significant price improvement. So a full increment or half the spread if it's a penny. If it's greater than a penny, maybe a full penny. And if you want to trade off board in a dark pool, 6,200 shares minimum trade size. so that you required the markets to come together, which there's what they're supposed to do. And the market maker has a role there, but also natural buyers and sellers have a role there. And I think if you put all those together in a pilot, that would be a pretty interesting test kitchen to experiment with.
If I could, I might not be so eager to join that pilot. We have an arrangement where we use an intermediary executing broker, and we believe in that model because, one, we can establish service level agreements which govern execution quality, price improvement, liquidity improvement, and these are things that exchanges don't necessarily offer. They're not going to agree to give me these things. They may be there in the marketplace, but an executing broker will commit to these things. And if he doesn't live up to them, he will then have penalties attaching to our agreement. Now, an additional item is if there are systems problems, if there are failures, if there are software problems at that executing broker, he'll be responsible for them. And what we see in the SRO, when you send it to an exchange, they're going to say, wait a minute, whoa, this is, we have absolute immunity. We're an SRO. We're not subject to any obligation to take care of the marketplace. Well, that's a problem for us. And so we think that it is a good model to have that intermediary in between.
Paul?
I think where this leads me, hearing all this in the earlier panels, is it's really a conversation around what are we really solving for? And there was a meeting in Washington sponsored by ICI of many of the people around here where when you got right down to it, what are we trying to solve for? One of the things that everybody seemed to conclude in the room is that larger cap stocks largely trade well. Nobody's really very concerned. It's when you get down into smaller cap issues that those issues come out. I think from a perspective, though, of operational risk, I think we all agreed that the level of fragmentation that's gone on, it's not clear where the utility to the markets has been granted. And of course, there's now 13 different public venues, exchanges, where stocks trade. I believe there's a similar number in the options world. The option world, I think, could schedule up to 16 by the end of this year with all the things which are out there. So I think, and of course, the SEC grants those. So I think we've gotten to a point where what is it in aggregate that we're trying to get to? Now, Andy just proposed something throwing a number of things in. And I think what you realize, the more you get into these conversations, there's no one silver bullet. If you're going to look at the market structure, it unfortunately, and somebody said it might be 2020 by the time that study is complete, it's complex. We've created a really fast, complex, technology-enabled system, so you just can't tinker with one little thing. But I do think we've got to try to narrow down the field and come through with something. So there were, cross-market suggestions. There was some things which I would call trade at for reduction in access fees. But things we do know is access fees clearly create a distortion. So I think we could try to say, okay, if we tried to get rid of some of the distortions, what are the pieces that have to go along with that to get there? And, to reiterate my earlier comment, I really think because we're in such a fast technology-enabled world, you have to start with market data. Market data, to me, is the fuel of the system. You wouldn't run a sophisticated race car and try to win a race if you threw leaded gasoline in. You have to make sure you start with simple things. I think making sure that's good is a fundamental requirement as an input. Then you can keep moving down some of these other paths. And ultimately, I think reducing the operational risk in the system is what investor confidence is about. We'll get people in because when people hear an IPO failed that was a huge retail IPO, or when they hear of a flash crash, a number of people have made this point. I believe it to be true. Retail has never had such a good scenario. Ironically, they don't understand any of these issues with the microstructure. What they hear is what's on the news and what they read. And chances are that's what Congress actually hears a lot more about as well. So I think what we've got to do as an industry is create a safer, more robust environment. SCI, which is out there as a proposal, is a start toward that. But it's almost, in my opinion, the more we just add more exchange medallions out there, you're creating more complexity for not obviously improved economics. But again, it's easy to do because the access fee and the way you're forced to route to everybody and can share market data, which was another theme that was brought up, almost makes it a cheap alternative to just get going. And as a result, we can experiment. So I don't know where the elements of the competition in the model versus the public policy benefits start to, balance back through the system. But until we really decide what's the criteria and therefore how we're going to measure it, what metric will we look to measure it? I think the one metric that the SEC I've heard most use over the last decade is narrowness of bid-offer spread is the definitional benchmark that they've used over time. I don't know, Commissioner Gallagher, if you'd agree with that, but I think that's probably been the simplest heuristic. And as we said earlier, although you may not want people to protect your clients, I think the SEC views it as their obligation. So you're getting the first help.
Commissioner?
Yeah, hopefully I'm on here. Yeah, no, I agree with you, Paul. The emphasis on spread is obviously pervasive at the commission. I guess, to one of the points you made, which really resonated with me is, the investors and congressmen and SEC commissioners for the like, will watch TV and hear about confidence through that. And one of the things when you talk about a holistic, comprehensive review, and I think, Andy, it'll be a little quicker than 2020. I see Dan Gray out there somewhere. It'll be on him anyway. We'll make him work faster than that. Is that, it's hard to go and eliminate, the trade through, rule and then go out and say, we've solved it. We're now below 30 mils here, and we've done this here, and everyone should be confident. I mean, you just have a fundamental advertising and understanding issue. When people think that the markets are slanted against them, when they worry about fundamentals in the bid offer, which is the basis upon which the whole regulatory paradigm is built. I do think a lot of this stuff will help around the edges. I worry about pilots generally because they always sound good. Talk about best intentions. I think there's some major operations still running on a pilot basis that I have no idea when they're going to end. So to me, they might make sense. They might be a good lab, I think Professor Needle said, but I don't want that to detract from what I think is something we must do, which is this more comprehensive look.
Sort of to link Andy's point with Paul's in terms of introspection and the role for policymakers. I think, confidence-inspiring things, whether it be Reg SCI, Consolidated Audit Trail, that really is something that we all can agree. The regulators certainly have a role. You get into dynamics of order flow, levels of toxicity. Some of these concepts date back to regional exchanges in the mid-'70s. Liquidity rebates started in the late '90s. This stuff predates Reg NMS. So I would caution you, from diving too much into that kind of detail in terms of the role of regulation. Does it resolve things? Does it make things more complex? But we all can certainly agree that when it comes to investor confidence, why are we having operational errors? How do we react to them? How do we improve as an industry? Limit up, limit down is a great start, but we clearly need more. Consolidated Audit Trail, in our view, can't happen soon enough. Maybe at different cost and maybe with a more, sort of improved governance structure. But as a confidence-inspiring measure for investors to know that we've got an informed SEC on the watch with good data, it's hard to beat.
Just like,
go ahead, Jeff.
just to follow up on Paul's comment about market data, this is something that Schwab's been concerned about for many years. Going back 1999, we filed a petition for rulemaking with the SEC to address the market data structure. And this market data system isn't a construct of NMS. It's really a construct of 1975 Act amendments. It hasn't really been changed in almost 40 years. And yet it is the oxygen of the system. And there's very little that's developed new. The consolidated SIPs are still owned by the exchanges, and still that product is, it doesn't show depth of market. It's slower than the proprietary feeds that the exchanges all now have developed. And of course, you can buy the proprietary feeds, but for a firm like Schwab, it'd be prohibitively expensive to be able to show that information to all of our clients because you got to pay by the eyes. You got to and for 10 million clients, it's just impossible. So we really do need a wholesale look at the market data structure, because without data that is most, giving you the most transparency into our markets, you really are going to.
So how do you do that? I hear a bunch of folks here saying, well, look at pilot program, this, that, the other thing, right? That's all good. But how do you do that? Look at the data stream, the data in the funding stream there, without going back and looking at some of these other issues that addressed at the same time. So you come up with your solution, and it's a reform of the pricing mechanism, but we didn't address 2 or 3 other issues that that come out of the SROs and what have you. So how do you do it in just a piecemeal approach?
Well, I mean, I could give you ideas how to
Okay.
fix the market data system. Frankly, we have, by rule, we have to submit our data to the exchanges, and then we have to buy it back by rule. And it just seems to me that as a fiduciary for my clients' executions, I'm going to give them the data they need. I don't have to be told by rule that I have to buy this piece of data to show my clients. I'm going to go out and how else could I make a best execution argument if I don't give them?
But if you fundamentally change, not to get into totally on this, but if you fundamentally change the remuneration, for the exchanges from the market data, right, under some variation of what you're talking about there, that changes a whole host of other things for the exchanges, and then you have to begin.
But it sounds like we're headed down it. We're looking at their SRO status. We're looking at whether they need to file rule changes.
Right. So in other words, we couldn't. I don't know.
In the whole context of that,
you couldn't just say tomorrow we're going to come up with a pilot program or in a thoughtful period of time on market data and go forward on that. And then at the same time, we're going to do a pilot program on the SROs because they're going to be potentially running at cross purposes on how you do it. And so you're going to come up with 2 different scenarios here. Well, the market data seems to be working over here, that pilot program, but it's not working over here for the exchanges because we still have not completely tweaked out the SRO structure and how that's all working, right?
Well, that's why I think Commissioner Gallagher is correct to have a comprehensive review.
That's going to take forever, then.
Yeah.
But I do think we can, while we wait for that comprehensive review, and I'm delighted to know it's going to come sooner rather than later. Commissioner, thank you for that. Sooner than 2020. But we certainly can, it seems to us, most of us in the industry have grown pretty weary of the fact that we don't seem to make a move on anything.
Yeah,
So
okay.
there's always a reason to delay it. So Dodd-Frank and Volcker and this and that. And, it's like, can we just get started with a couple things that we
Sure.
could agree that are worth looking at? And it sounds like there are a number of people that want to get into locked and crossed markets as an experiment. Certainly the payment for order flow, maker-taker kind of thing is there. But I will tell you, I had the great honor of serving on a SEC advisory committee on market data in the late 1990s, I think. And my goodness, there were 50 people on that committee, and the self-interest was extraordinary. So I would urge the congressman to perhaps pick anything but that as something to tackle.
Did you?
Mr. Brown, how would you propose to improve market data?
Well, I think we have to look at new ideas about, having the exchanges be able to market their data. I think what we've heard today is that marginal exchanges have had difficulty are able to survive because of the market data stream that they can generate. So I think whether or not that's a subsidy based on really the value of that the larger markets are actually bringing to the bid-ask spread and to the data that is generated is something to look at. And so we can, I think in my view, start talking about having not there's a rule called the vendor display rule, which I think we could get rid of, and then allow markets to sell their data to broker-dealers who are going to purchase it because they need it, and they're going to need it for their clients. And let markets generate what is best to show their clients. You don't have to force feed that.
Do you have some other questions, Carolyn? Okay, Commissioner?
I'd like to go back to Mr. Brooks. When you gave an analogy earlier, you said one of the problems we have with confidence in the market is that some people know the end of the race before the race is. They know the end of the race and then they can bet. How does that happen in the markets now?
I'm probably not the expert on this. Some other people will know more about it than I do because it's more fundamental to their business, I think. But our understanding is that, it was referenced earlier, but the market really has been myopic about speed and the pursuit of speed. And speed armed with data might give you an advantage. And I think our view is, as we think about fairness and a level playing field for all investors, any information about true market data, buyers and sellers, price, should be disseminated equally. And then what you do with that data, go crazy. That's up to you.
How is it distributed now that it's not distributed equally?
Well, maybe I'll defer to somebody who knows more about that than we do. But our understanding is there are separate data feeds. that are able to be purchased, and that perhaps some people might get an advantage there that really doesn't belong to them in our view, but belongs to the marketplace.
Well, there have been some complaints that I've heard about high-speed trading, that they are able to do exactly what you're saying, and I don't know if that's true or not. If anyone would like to comment?
I guess I'll comment on that as a representative of the high-speed trading. I'm not aware of any data feeds or any advantages that we are able to purchase that are not available to the public. I think it's very important that the exchanges make sure that their facilities, that their data feeds, that their co-location, that everything that they offer is available on fair and reasonable terms and transparently to the public. And that's my understanding of how it works now. There may be a good opportunity for investor confidence for the regulators to be able to look into this and say that that in fact is the understanding, because I think this is a myth of the markets that really I've not been able to track down. And certainly if my competitors were getting advantages that were not available to me, I'd be quite concerned.
Is anyone able to get data facts faster than others? Amy?
I think there's just I think there's maybe just a fundamental misunderstanding here. So exchanges must represent their quotes into the consolidated tape system, which we all do, and we all do that as quickly as possible. At the same time, we send our direct market data to customers, anybody and everybody who wants to take our direct market data. We send the data to the consolidated feeds as quickly as possible. By definition, the consolidated feeds have another hop. They process the data, consolidate it, and send it out to everyone. And I will say, since BATS became an exchange in 2008, we've made a large effort as part of the consolidated tape to ask for and petition for the improvement of the consolidated tape system, such that it is far under a millisecond now for the consolidation and distribution of that data. Now, it takes time once you consolidate the data to send it out to wherever the recipient is. And I think the misunderstanding may be that while exchanges make co-location and technology available to any and all who want to take it, not every customer avails themselves of every service that we offer. And that's technology, that's order types, and if the requirement is that everyone must avail themselves of every offering, then there's not much competition or segmentation.
What about real-time data? There's a lot of conversation now about real-time, that some are saying that they can supply real-time data. Is that being supplied now in the audit trail, or what is the status of it? And
so real-time data is being supplied and has been supplied as long as the consolidated tape has been available for decades. Exchanges have been required to submit their quotes in real time as fast as possible to the consolidated tape. So that's happening every single day. You can go on Bloomberg or whatever and look at the quote.
So we're not talking over each other. I think what the Congresswoman was asking about was the surveillance, so the audit file. So this will go into CAT.
Yeah, thank you, Commissioner Gallagher. So currently today, the data that's used for surveillance is dependent upon who's doing the surveillance. So FINRA is doing some surveillance. BATS, we have our own surveillance department, and we're doing that based on data from the BATS market. But there's no single source of all consolidated data for surveillance purposes. What's sent to the consolidated tape for trading does not include what broker was behind the order, or beneficial owner, or in any of the additional annotations on the order that would be useful for surveillance. It's just the price and size.
I would just add that in addition to speed, which speed is what it is. I don't really know how one regulates that. But there's a robustness to proprietary market data feeds that hasn't been discussed. I mean, it was touched on by Mr. Brown in regards to the fact that the SIP or the consolidated feed only has top-of-book data, doesn't have depth-of-book information. But that's just the tip of the iceberg. We, on behalf of our institutional clients, which manage retail money, think it's their information to disclose or not disclose. Much like when you go to a bank and you give them your social security number, you don't expect them to sell it. Well, when we go to an exchange and we have information about our orders, it gets sold on proprietary data feeds and in reports that go on thereafter. We opt out of them whenever we can because we'd like to protect our information and our clients' information to the extent possible. So when looking at market data, if and when there's a robust discussion about it, in addition to the speed aspect, which geography is geography, a consolidated feed is always going to be slower. than a proprietary feed, unless one is trying to normalize for that, which is a conversation probably for another day. The robustness of the data that's in the feeds and the reports, you've got real-time market data, to the Congresswoman's point. And in addition to that, there are follow-on reports about which orders get routed to which venue, who provided what liquidity. Was an order that was never shown and never executed at all, was that ever sold to anybody? Yes, it is. So most people don't know that. So when one discusses market data and understand, obviously, in a for-profit motive, which the exchanges are entitled to have, obviously, one of the big, an area of profit is selling market data, both in real time and in reports. And the reality of it is brokers who represent their clients don't have the ability to limit that information being sold, which we think is not the most even of playing fields beyond speed.
And when some of that information is sold, is in fact somebody able to arbitrage that and get an advantage with the 2,500 plus order types we have out there? I mean, and we want, it seems that's what we hear. That's what we're told by broker dealers and others engaged in managing our order flow. And that's where the person behind the curtain, it's a little interesting. And we'd love to see, and I think Mr. Baxter in an earlier panel called for a little more transparency to what's going on in some of these venues and in some of the routing logic that's happening in the marketplace.
You are certainly welcome to come and visit us and spend a lot of time about market data. I think what you would find is that we release our data simultaneously. As Richard said, we do not have created an advantage for any other player in the marketplace. Matter of fact, our data is freely available to anyone who wants it, both on a proprietary basis or otherwise. It's the same rate schedule. We don't change it for certain people. We don't make it available to only certain types of people. It's freely available to everyone. It is not designed at all to provide advantages. It's designed to provide a better trading experience for all market participants. I would challenge Mr. Steiner a little bit in that I am sure that his firm actually buys the proprietary data feeds for use for his customers and for his brokers so that they can operate in the marketplace in an efficient way. So it's interesting when we talk about how we want to try to pull back pieces of it. Everybody wants the full data except for their own data.
Right.
So what we've been striving to do is to create an environment where the data is available for everyone to use on an efficient basis, which we think makes a more transparent, more effective market for everyone to interact with. And that is the full intent of the data business, is to provide that kind of service.
I guess another perspective, Congressman Maloney, to your question. So we're an agency broker. We use a lot of technology to solve problems for folks like Andy. I think it's absolutely the case that we're not deprived of anything. So any proprietary feed, we can contract with an exchange and get it. I guess the question is, are we working a little bit too hard, on issues like, order book data, minutia, maybe over-investing in technology? Has the pendulum swung such that, sort of use of capital and resources is just too much on the technology side, that we've availed ourselves from a lot of benefit over the past 10 years, and the incremental work we need to do to keep up is taxing. And I think it's taxing to us as a broker. It's probably taxing to the buy side as well. And that's when you hear complaints about the complexity of the market, people not understanding it, and that eroding confidence. I mean, a lot of where that comes from, that we are working extremely hard to keep up with a very, very complex environment.
A lot of economists keep talking about the lack of investor confidence. And would any of you like to comment on it and things we could do to improve investor confidence?
I mean, I would just say that we've got, a fair amount of what I would say is needless complexity and fragility that has, to Mr. Andreessen's point earlier today, caused this interconnectedness that we've all strived to have. These interconnected markets has a downside too, and the follow-on effects of the technology and the speed that we now have is probably cause for a look back and to see if maybe we should adjust things. I saw an analogy, maybe a couple months ago regarding, the interconnectedness of our marketplace is so different than in really any other industry. If a jar of peanut butter falls off a shelf at a supermarket, there's a problem in aisle 2 there. There's not a problem in the produce aisle. There's not a problem at the supermarket down the street in 7-Eleven, right? But if we have a problem here in one of our exchanges, or really anywhere with the market data for that matter, it's systemic almost immediately. And so I'm inclined to think one way to address investor confidence would be to address the fragility and the rigidness of the marketplace, which in full fairness to the SEC, with Reg SCI and limit up, limit down, and certainly with CAT providing much better data to study the markets, hopefully we'll get to a place to basically make the market a bit less fragile.
I just add a comment. I think, again, investor confidence, it's this very slippery slope. It's easy to say. It's an easy thing to throw at. But at the end of the day, I don't think any investor truly understands almost any of the stuff that we've been talking about. They see on CNBC or one of these channels the opening bells and so forth. They see people ringing. That's their view of what the market is. That is not what the market has really matured to over the last decade or so. So I think the investor confidence issue is a result of the market functioning well or a result of the marketing not functioning well. And it comes back to these themes about, to me, we just talked about a lot of attribution of market data, what's in there. I'm more fundamentally concerned the quality. So the limit up, limit down is a brute force mechanism in a fast world just to stop things. Actually, pretty sensible. I applaud it. What would be the same brute force thing with market data? When you start to get multiple venues saying crazily different things, do you halt? Do you time out? I think in a way you want to stop the market from getting to a bad place, not say, well, once we get to the bad place, how do we take trades down? See, that you've already lost by the time we've gotten there. So to me, most of the issues around investor confidence have to be in relationship to how they're feeling and what they're hearing. Those are the inputs, because everything we said, literally, I don't think we shouldn't expect them to get that, frankly. They should just have confidence that the regulator's doing their job, they've got good data, the system is robust and stable, and when there are problems, they're fairly dealt with. And I think just fairness, it's plain and simple fairness.
I think this is an important question about investor confidence. I think that there's a lot of good ideas around the table today about reforms that would actually make the markets better, that would make them more stable, that would lower costs for investors, that would make them more transparent. And I think all of those contribute to investor confidence. But one thing that hasn't been discussed today is a frustration that I've had, which is that the SEC and other regulators are not in a position to go out and say, you know what, I looked at this and it's okay. And nobody ever does that. So any crackpot, any salesman, anyone can make a claim about what's going on in the market, and there's not a rational, responsible expert agency on the other side who comes out and says, you know what, I looked into that and there is a problem, I looked into it and there's not a problem. So a lot of the challenges go unanswered. And I don't know how to solve that. It may require an act of Congress to free up some of the confidentiality restrictions in certain areas, but I think that would go a long way to restoring investor confidence.
I think that's a really good point that you just made. And we used to have a fellow that worked for us who used to say, today is the hardest day to invest. And so if you think about it, there's always a rationale that you can come up with that'll say, I can't invest today because there's some issue globally and this isn't the best day. But for investors to be successful, they got to ride through that and stay invested in the markets. And all of us have an obligation to try and answer those questions. Hey, we looked at this, and frankly, we had a technology snafu. It was dealt with effectively. We've done the right thing. Fairness has been affirmed, and we move on. And I think if we could rededicate our efforts collectively to do that, that would probably help in the investor confidence issue.
I mean, certainly telling your investors to take a long view, this whole idea of speed, retail investors don't need that. They need to stay in the market, like you just said. And if they had stayed in the market in the financial crisis, they'd have all their money back. And so, that's an important part of just keeping people from making bad decisions, trying to advise them.
So we've been talking on the investor confidence side, a couple different points. One, your last point is on speed and what have you, but I wonder whether there is an overall matrix of measurements on that you can actually do. Earlier someone said, as far as you've been cheaply looking at what the spread, just to see where that is the cheap one. But was it this panel or the earlier panel that was talking about for example, the actual amount of capital formation in the markets and the number of IPOs that are going out there now? I think you raised some of those points earlier. So should we be looking at a broader selection or matrix of barometers for the marketplace for everything that we're discussing here, whether we do all this in a holistic approach over 20 years, or we do this over in a pilot program on a weekly basis? Is there some better barometer or measurement tools that we should be using then?
Again, there was a group of exchanges, broker dealers, institutions. I mean, a whole group of people who were just meeting about these type of topics a few weeks ago in Washington. And the reality is, we had a hard time, frankly, trying to come up with what the best barometer is. But I think it's a mosaic. I just don't think there is any one factor. And again, we threw out a couple of ideas. Like there's aspects of how the world has changed where exchanges are for-profit organizations. Now, that wasn't the case some number of years ago. So there's aspects of what exchanges do which are public policy based, and there's aspects which are, their free model to try to profit and do best for their shareholders. The public policy side, we might be able to kind of think about in one light, and then the for-profit side, we might be able to think about in a slightly other one. But when I think about the exchange at its core, the public policy is that sense of being durable and stable and all these type of things which go directly toward confidence. I think, there might be metrics on how durable is our market structure under times of stress. There might be measurements about market data. How durable is the market data coming out of different organizations responsible for that in times of stress? I mean, so you might be able to put metrics around some of these different factors, and that will give you a better mosaic of the strength of the overall system, because as was mentioned a number of times, we're very interconnected. When pieces go down, it starts to take down other pieces. And I think what you want to do in any system like that is you want to be able to isolate, but we also have to stress test the system. You wouldn't design an airplane and let it go up without lots of different stress tests. In a way, we did Reg NMS with no stress test. It was a political, to some degree, negotiation, which had lots of different elements going on. Nobody disagreed that we had to head toward that direction, but was it designed with that in mind? No, actually, I don't think anybody ran it through the economic stress test model. What happens in the time of, when these, so we've learned some of that stuff along the path. And as was mentioned by someone, the Associated Press twitters something or a hacked Twitter of something, and you get the market to react. Is that good or bad? The people that happened during this meeting, most of the people in the room said that's what's supposed to happen. The market digested a piece of data, reacted. Well, that's what efficient markets are about, reacting. But then when they found out it was fake, it reversed. Well, the markets are going to learn what's good data and what's bad data. They haven't learned these lessons, right? So unfortunately, with speed comes some other unintended things which the market hasn't figured out how to manage that. How do you find out if a report is a fake report or a real report? What's a credible source? How do you start thinking of these things? So unfortunately, I think there's some lessons that we haven't learned because they're brand new things in our era. But I personally don't know if the one metric anymore fits. And I think we probably have to move toward a more mosaic. But I think it's a very challenging question. You need a whole industry to help figure out what some of those metrics are.
I think that's right, Paul. I think not just, bid-ask spread in the narrowest sense is probably appropriate. There's lots of ways of measuring bid-ask spread, but there's also very well-established metrics of price efficiency, very well-established metrics of micro volatility. All of these have been measured consistently by academics and regulators and market participants over the recent years, and I think they all paint a very consistent picture of things getting better. If they were to start getting worse, then I think, looking across all of those metrics, that would be an important input into guiding regulation. And it's also as an opportunity to measure ourselves as market structure changes. Are we actually making things better?
Thank you.
Before we end here, one thing that's been on the table, an obvious point made that I don't want anyone watching this to think hasn't been duly noted. The notion that Paul was talking about earlier, that the fascination on spread, right? And we're going to talk about how investors are doing better now than ever because the spreads are so tight. While at the same time, we're talking about literally using the word toxic as to the sunshine markets, the exchanges, right? And that's where price discovery is happening right now. I mean, these two things really don't go together at a very rudimentary level, and it's an obvious point to make. It goes to the heart of why we're here today. But we talk about investor confidence, and when we use words like toxicity and then price discovery and NBBO, whatever that might be, that flows from it, I think all the more it's time to take this holistic review.
Comment? Yeah. To my vice chairman.
We're about at the end of our time here, and I just wanted to thank you, Mr. Chairman, for convening this meeting, and it's been good to be with you, Mr. Commissioner, and the other members of the House of Representatives here. I just want to thank each of you all and to all of the folks that have participated in the panels. To me, it's very, very helpful to have your insights. Obviously, we've heard a lot of the challenges laid out today, and as we go back to Washington, we will take these with us and look forward to being able to work with each of you as we try to tackle these challenges going forward.
So thank you for that. Thank you for your participation. So after this, I believe I have a TV hit. We're on one of those 24/7 financial service news type programs. And so I'm just now mindful of the fact if I say that we had this hearing and there was a toxic discussion as to what Congress may be doing with regard to the equity markets, should I guess I won't have that much of an impact on anything. So
We'll make sure not to trade on it.
yeah. I don't think people trade much of what I say, so that's fine. So again, I do very, very, very much appreciate this panel and all of your input, and those members who I've seen here before and the new folks here as well. So thank you very much. And as with the other panels, I found this very enlightening, and we probably will be, circling around again with you folks. This is the beginning of our process as far as Congress is concerned. Hopefully we have also sent some degree of message over to the SEC in an informal manner as far as the significance and the importance of all the issues that this panel and the other panels have discussed so far. So thank you for helping us to engage in that process. Thank you.